Good evening. It is Dan Kerr's DK Analytics. It is January 31st, 2018. We're coming to you on the heels of Donald Trump's State of the Union address last night with a video update. Thanks a lot for tuning in. The title of our video is Trump's State of the Union Address, President Trump's State of the Union Address. American greatness financed by more debt. Mr. Trump, President Trump, showed great patriotism, lots of rallying around the flag, and welcome, very constructive, and numerous federal circuit court appointments, judge appointments. Judges that are pro-Constitution. Longer term, this portends well, at least taken in isolation, for a return to the rule of law. If the current appointment trend is extrapolated, which the odds of which are very good, then this would be very good news indeed, especially given the prior administration's tendency to stack courts, federal courts, with judges that were not originalists and in essence found a way to block a return to the rule of law when decisions got before federal courts. So this is a very solid, very noteworthy, very good long-term trajectory or development thanks to Donald Trump's assumption of the presidency. Donald Trump also did a great, quote, America is back, unquote, sales job. Trump has tremendous motivational speaking ability, and he can speak to America's heart and heartland very well, appealing to everyday Americans, the people that make America work. That's why he won the election, which we actually bet to people he would, but that's neither here nor there. In short, President Donald Trump connects very well, which is a great leadership quality if the proposed policies emanating from that same leader are sound. Related to that, and less euphorically, we also see disingenuous aspects of his speech and his policies, conflicting disconnects, and frankly, reckless aspects, sadly reckless aspects to his speech and his proposed or related policies. Examples of this include things such as what used to be an ugly stock market bubble that would be pricked by higher interest rates, according to then candidate Trump, is now proof that President Trump is doing a great job. Yet, Standard & Poor's multiple, or PE, is higher than ever. It's trading at over 26 times earnings, nosebleed levels. Meanwhile, margin debt is at an all-time record of nearly $600 billion. These stocks aren't in strong hands, they're in weak hands. And if sentiment changes, that's a lot of selling pressure that will come into the market. We have a recession that is way overdue. Why do I mention it? Because recessions crush earnings, EPS, easily by 30 to 50%, 40 to 50%. 70, 80%, the last recession with big bath accounting write-downs, but let's just call it 50%, run-of-the-mill recession, easily. But this is the market that is no longer a bubble, according to now President Trump. Meanwhile, U.S. aggregate debt is growing. That is at all levels, all government levels, corporate levels, personal levels, family levels, is growing between $1 and $2 trillion a year in excess of GDP growth. In other words, GDP is increasingly debt leveraged or leveraged. And interest rates are beginning to rise smartly, at least as measured by the 10-year Treasury, which has gone from an all-time low of 1.4% to 2.7% just recently. We go over such dynamics and such valuation compression scenarios on stocks and bonds in our last two posts. Post 25 deals with net present value impact of using different interest rate assumptions. Recall that the interest rates we have now are boom or bubble level, that is very low with very high bond yields. And also recall that markets are not reversion to the mean machines, they are reversion beyond the mean machines, meaning analysts get it all wrong. Sorry, with all due respect, when they talk about reversion to the mean, PEs or bond yields spend hardly any time at all at the mean. It's like they blow through it on the way up or on the way down. On the way down being from a boom, currently insanely valued bonds and stocks, to a bust, low PEs and high interest rates, high yields, in terms of either today's bubble levels or compared to mean yields or PEs, which again we cut through pretty quickly. Those discussions are to be found again in post 25 and 24 for details. Please have a look. I think you'll find them of interest, especially given our valuation conundrum. And trees don't grow to the sky, Mr. President. What used to be what used to be a fake unemployment rate. Again, we're going through disconnects and less than, we'll call them disingenuous remarks that we think reduce the credibility and impact the policy that President Trump pursues. But what used to be a fake unemployment rate when Trump was a candidate is now lauded as the real deal, even as a civilian employment rate, the civilian labor force participation rate, rather, at 62.7% is hovering near 4-decade lows. And that same labor force participation rate at near 4-decade lows of nearly 63% is flattered by numerous losses or large losses over time in full-time jobs that were substituted by 2 or 3 part-time jobs. So it's flattered by part-time jobs, which typically pay squat and offer either less or no benefits. So any way you slice it, it's not consistent with the low unemployment rate that Trump now touts. All right, it's not honest. It's disingenuous. President Trump talks a lot, and to his great credit, about regulatory reform, and he's been doing some amazing things. And he talks about the regulatory reform, which is so very necessary, liberating business to hire and to invest. According to the American Action Forum, a group, a think tank, regulatory relief of $560 million per annum is in the pipeline on an annualized basis thanks to Donald Trump's executive order 13,771, I think, in which he mandates that for every new reg, 2 regulations must be cut. While this is laudable, it is frankly nothing but a rounding error compared to over $2 trillion in estimated annual regulatory compliance costs that various sectors of the U.S. economy has to absorb, which could go to hiring or productivity or CapEx or R&D. And while a sharp reduction in the Federal Register pages where federal rules and regs are published from Obama's run-to-the-finish line bloat at the end of his administration is also very laudable and promising, we truly wonder, how any true or lasting reform or reforms can be achieved in the all-important regulatory quagmire, the straitjacket, until regulatory agencies, which are housed in the executive branch, they report to Donald Trump, but until regulatory agencies are shut down and statist/leftist unconstitutional bureaucrats are fired, especially given the risk that the GOP, which presently controls the White House, the Senate, and the House, is not likely to hold that majority or control all those three sectors of the federal government for a very long period of time. In fact, Donald Trump, 2-3 days ago, warned about the House potentially flipping into Democratic hands. And then it's going to get a hell of a lot harder to do regulatory house cleaning than it already is today. A disconnect. We're talking about the disconnects, disingenuous aspects of what he's saying, and how that conflicts with sound policy decisions and proclamations. Another disconnect, Trump trade tariff threats, Trump protectionism. While going to Davos and meeting with the high and mighty in a high Zoot Swiss Alpine village, where leading industrial people and other people of globalist note gather to figure out how we should all live and better align our interests with theirs, which doesn't end up doing the average person much good, as we know, but it helps float their boats. Donald Trump was touting that America is back. America's back in business, tax cuts, regulatory reform. Yet soon thereafter, Trump was very quick to slap high tariffs on imported solar panels and imported washing machines and on select steel imports. Three big issues here. First, lots of stuff just isn't made in America anymore. So higher tariffs line government pockets, the higher tariff, and hurt consumers and producers alike. Think of those installing foreign-made solar panels or using cheaper foreign steel and finished products that are then successfully exported outside the United States that no longer are competitive. It's a very difficult thing. We outlined this in Post 18 as well. Once you get into these trade spats and tariff round increases, it gets ugly. Second, raising U.S. tariffs will quickly result in higher tariffs on U.S. exports. Again, it gets ugly. Third, we all know what can happen if this gets out of control and we have one-upmanship. In other words, it spires into a trade war between nations. It spelled Smoot-Hawley revisited and a 30s depression. Now, Donald Trump shouldn't play with this fire, especially not given the current paucity of American manufacturing vibrancy. It's a hot potato. Speaking of policy destructiveness, federal government spending is up 3.8% year over year. It's been averaging 5-6% growth, well in excess of tax receipt growth over a protracted period of time. That's why we have these deficits. And we're moving back into, you guessed it, expanding deficits. Now, we've got federal government spending growing at 4 or 5% a year, and this is set to increase at a more rapid rate as Trump touts various new spending initiatives from infrastructure to military spending, and the Democrats will be more than happy to up his proposals on infrastructure. When spending is in question, all politicians like to vote it in, especially if it could be financed via the printing press, right? But these various spending initiatives that he is suggesting promise to raise federal spending to even higher levels, even as tax rate reductions will pressure tax receipts and weaker economic growth, which can happen at any time and is overdue, for a host of reasons, including that the business cycle hasn't been rendered academic, including our toxic public policy stew, our malfeasance at various levels for nearly a decade. The economic growth, if it weakens to an even lower level, would dramatically worsen the need for government to increase spending on welfare, on transfer payments. So not only could you have the decrease in tax revenue, but you could have a substantial increase, recession-oriented increase in government safety net spending. And we would have, you guessed it, mushrooming deficits. As we've mentioned before, speaking of mushrooming deficits, and we've mentioned this in posts and in videos, we think we could see, given the dynamics at play here, given historical precedent, we could see a $1.5 to $2 trillion plus federal U.S. government deficit within a few years, if not sooner. And if the Fed really sells $600 billion of treasuries a year, at what price? How high of a yield will investors in the rest of the world need to soak up between $1.5 trillion and possibly well north of $2 trillion of U.S. treasuries possibly coming onto the market? That question is particularly apt as the rest of the world finances the United States goods and services deficits to the tune of roughly $500 billion per annum on average. America is a net debtor nation to the tune of $8.1 or $2 trillion. That's a lot of dollars overseas that could come home if they don't like policy, right? When, such as Munchkin, yes, I state that on purpose, U.S. Treasury Secretary decides to talk down a dollar and he'd like a lower dollar, that's very dangerous. Talk about playing with fire. I mean, if you're in a low interest rate environment with a falling currency already and large external financing needs, you don't push down your dollar through talking it down, right? Because you're driving away potential investors and thus de facto raising the cost of borrowing, especially if sentiment shifts or confidence wanes. And by the way, here a noteworthy observation. Since when has currency debasement proven to be a panacea for doing away with trade deficits? Haven't Japan and Germany had strong currencies until at least the euro was imposed for decades and had over decades large trade surpluses? Moreover, hasn't the U.S. since 1971, when Bretton Woods was terminated, had a weak dollar punctured by periods of fleeting strength, a weak dollar in which over a 45-year period the value of the buck against OECD nation currency basket is down about 80% over 45 to 46 years. What's our point? If a weak currency was the answer to reversing trade deficits and turning them into massive trade surpluses, why does America have such a large trade deficit? In short, that's a lot of hooey. One cannot simultaneously grow a spendthrift federal government, cut taxes, and then expect good things, right? You can't grow spending by $300 billion plus, reduce tax revenues by about the same magnitude, about $300 billion estimates, probably be more than that, and then add it to a $700 billion deficit, which in turn is growing a $21 trillion federal debt, and expect good things. Any kindergartner knows this, Mr. President. In short, President Trump is not leveling with the American people in terms of what really needs to be done for the benefit of future generations, who will otherwise be hobbled by mountains of debt and the related financing costs, and it won't be at 1 or 2%. It'll be multiples of that. It'll be crushing. To avoid this, what should Donald Trump really be focusing on tough love? On cutting government spending, however politically difficult. If not now, when then? When is the presidency, the Senate, and the House going to be Republican controlled again? When, if not now, when then? So, cutting government spending, achieving a balanced budget, aggressively pursuing litigation reform. U.S. corporate legal costs are roughly 3 times that of the OECD average. Of course, Donald Trump has a very litigious background, so maybe he's not capable of going there, but this is very important. And trying to assure long-lasting corporate or regulatory relief, that has taken those agencies down, firing the stuffing out of bureaucrats to the extent that they're not tenured. Really difficult, but that's where the long-term change in regulatory environment is to be found. And last but not least, in Donald Trump pursuing honest money, solid money, precious metals-backed money. You know, Andrew Jackson, President Andrew Jackson, whom Donald Trump holds in such high esteem, did away with the second U.S. central bank. And he fought it tooth and nail. It was ugly, but it enabled much of the prosperity that ensued. Andrew Jackson's portrait happens to be in Donald Trump's office, and you can see it depending upon what pictures cameras take of the president with Andrew Jackson's portrait ever too far in the background. So, if this is who President Trump really admires, he ought to round out his efforts of righting the good ship before it's too late by returning or seeking a return to sound money. Let us really drive home the point on the Trump policy recklessness. America is some $68 trillion. Federal, all government levels, federal, state, local, and all at the corporate level and at the individual, family, or the personal level. So all government levels, corporate and private debt is roughly $68 trillion. Has been expanding between 1 and 2 trillion a year for a good long time. And GDP against that as backdrop is roughly 20 trillion. Now let's assume that, each 1 percentage point higher financing cost would equate to $680 billion in additional annual debt servicing costs. Huge. Why is this so material? Because a lot of companies and even the federal government have to refinance because they haven't gotten long-term financing when it was most available and cheapest. So if the 10-year Treasury, which is the benchmark for most other interest rates in capital markets, goes up, we were up from 1.4 to 2.7%. If that continues to go up, by extension, the cost of finance, the cost of borrowing for America as a whole is going to go up pretty much in sync. So if we went from 2.7 to 4.7, that's almost $1.4 trillion in additional interest servicing costs, borrowing costs that America would have to incur for 7% of GDP. Now that's going to offset and more any tax relief. And as we have written and stated many times, markets are reversion beyond the mean machines. And given the mountains of debt that we've accumulated, both solvency and inflation risks being resorting back to the printing press to get us even deeper into debt, in essence, and thereby threatening to create too much currency chasing a relatively limited supply of services and goods, those risks have been magnified. So we could easily have a 10-year Treasury. And remember, we're going to go from boom to bust, from 1 or 2% Treasury yields to 8 to 7 to 8. Under Volcker's tough love, we went to above 15%. But at that point, the U.S. had a third of the debt to GDP that it has currently, right? But let's say we went 5 percentage points higher, from 2.7% cost of financing plus a premium for risk. If you're a corporate, if you're a mortgage holder, right, you're not going to be able to borrow at the same rate of the U.S. government. But that 10-year Treasury is the benchmark upon which all the other interest rates are set. So if it goes up, other interest rates are going to go up in kind. And if the 10-year Treasury went from 2.7 to, let's say, 7.7, then you'd be looking at America's cost of borrowing going up by $3.4 trillion per year. $3.4 trillion a year, that's 17% of GDP. A non-starter. Our point, given huge indebtedness, relatively feeble manufacturing capacity of today's America, and income and debt-constrained consumers, higher interest rates could easily choke off and even reverse the positive impact of lower tax rates by magnitudes rather, because those tax rate cuts are financed by yet more debt instead of by government spending cuts. Sadly, too many of Trump's policies will ultimately rely on the very printing press that has gotten us deeper and deeper into debt, into yield starvation, into huge misallocations, into drooping productivity, and into accelerating solvency and inflation risks, the latter, inflation risks, being the largest stealthy thief of average people, especially in property theft, okay? Especially of retired people who depend on a fixed income stream and a halfway decent bond return. Furthermore, some color on the state of the consumer. We mentioned the consumer being debt-laden and facing issues income-wise given a shift from full-time to part-time jobs and low labor force participation rates. Year-over-year wage growth is at 2.4% overall and only 2.2% in the manufacturing sector, is not that vibrant. And it roughly lines up with GDP growth, which frankly is no better than Obama's tenure, also about 2.5%. But inflation is starting to pick up. We've got a housing bubble. It's inflation given monetary policy, right? We've got a housing bubble that has eclipsed 2006 highs, according to the Case-Shiller Index, and mortgage rates are rising briskly. In short, housing is increasingly unaffordable for most Americans. And by the way, just as a side, how can you have record low unemployment and low wage growth rates? Fake news, anyone? Meanwhile, the personal savings rate has plummeted to 2.4% from 5.9% 2 years ago, as record auto loans over 1.1 trillion and student loans over 1.5 trillion suggest tapped out consumers and substantial demand which has been borrowed from the future and won't be there tomorrow, next month, next year. Finally, growing retail sales, to the extent they don't reflect rising energy, food, or healthcare costs, are too often indicative of greater demand for overseas products, as any shopper in big box retail outlets in the U.S. will readily attest to. Translation, running down savings to spend more on often foreign-made goods benefits Chinese and other overseas producers, not domestic companies or domestic employment. What's our takeaway? What's our conclusion? Against the backdrop, which we have hopefully fairly outlined, the good, the bad, and the ugly, we continue to think that most stocks most bonds, and certainly the US dollar, remain in a bubble. The dollar and bonds are losing value. They're deflating a bit. The bubble is deflating a bit. But it's a slippery slope, especially once perception starts to catch up with reality. And that reality, coupled with an overdue recession, will ultimately pop the stock market bubble as well. In other words, take profits while you can in overvalued stocks and bonds and get out of the dollar and get into scarce real assets, vital assets, especially the food and energy complex, and into real money, physical precious metals in your jurisdiction, while seeking the safety of T-bill based cash, can't be bailed in. This all sounds, given valuations and developments, like a sound idea to us. We hope it does to you as well. We thank you very much for tuning in. We hope you found this of interest, and most especially of portfolio allocation use. Bye-bye.